revenue, and expenses. To understand the income statement, you must first understand some key definitions. Revenue or income. This is money earned by selling a product or service. You receive this money directly from end consumers, resellers, or distributors. Cost of goods sold, abbreviated as COGS. The cost to produce the products you have sold are recorded as COGS. For clarity, COGS is only for products that have been sold, not for products that are in inventory and not yet sold. Expenses. This is money paid out to sell your products and operate the business. It can include employee wages, sales and marketing expenses, interest on loans, and more. Profit. This is the money generated from your business activity that exceeds the costs of the business. If revenue minus COGS minus expenses is positive, it means you have generated a profit. If it is negative, you have losses. Profit is also called earnings. The income statement adds up all the revenue, COGS, and expenses and applies this formula. Revenue minus COGS minus expenses equals profit. If the formula above results in a positive number, then the business has generated a profit. If the number is negative, then the business has suffered losses. Here is the income statement formula visually. Revenue, which is money received, minus the cost of goods sold, or COGS, and expenses, which is the money paid out, equals profit. And that's the money made or lost. Here's an example that applies the income statement formula. Revenue minus COGS minus expenses equals profit. The company has product sales of $5,000, so that shows as revenue of $5,000. The cost of goods that are sold are $1,000. Now again, to clarify, it's the cost of goods that have actually been sold, not necessarily produced. You may produce more than you sell. COGS is only specifically the value of the goods sold. COGS is $1,000. The expenses for selling those goods or services and supporting the business are $2,000 for a total of $3,000. That's COGS and expenses. So $5,000 minus $3,000 is $2,000 in profit. So this business has generated a profit of $2,000. That's good. Here's another example. A business has product sales of $8,000, so that's the revenue. The cost of goods sold is $2,500 and expenses are $1,000 for a total of $3,500 in COGS and expenses. So $8,000 minus $3,500 is $4,500 in profit. That's good. Next example, product sales of $6,000 and sale of services for $2,000. So that's a total revenue of $8,000. The COGS are $3,000 and the expenses are $6,000. That's total COGS and expenses of $9,000. So $8,000 in revenue minus $9,000 in COGS and expenses leaves us with a net profit of minus $1,000. So that's an actual loss. If profit is negative, a company has suffered a loss. Losses in accounting are sometimes shown with negative numbers or numbers in parentheses like this, minus 100 with a minus sign or 100 in parentheses. Both of these mean negative $100 or a loss of $100. BusinessXP is the fastest and most inspiring training ever invented for future business leaders and entrepreneurs. Discover game-based experiential learning at business-xp.com.